Question 796. Broker Bart had an exclusive listing to sell an office building. Bart found a company to buy the building and arranged the transaction for a fair price. But when the seller discovered that Bart had not informed him that the purchasing company was owned by the broker's son, the seller canceled the sale. Bart now sues to compel the seller to pay him his commission for the cancelled sale. The court will likely rule: A. The seller is obligated to pay broker Bart his commission under the doctrine of specific performance. B. The seller and broker Bart should compromise with the seller paying 50% of the commission. C. The seller is not obligated to pay broker Bart any commission. D. The seller is obligated to pay broker Bart a commission because Bart procured a ready, willing and able buyer. Correct answer is C. The seller is not obligated to pay broker Bart any commission. Specific performance is a remedy to compel a party to perform the terms of a contract. Here, the seller cancelled due to Bart's breach of duty, so the seller is not in breach, and specific performance for the commission would not apply. Bart, as the seller's exclusive agent, owed the seller a fiduciary duty. This is the highest standard of care in law and includes duties of loyalty, honesty, confidentiality, and full disclosure of all material facts. Bart's failure to disclose that the purchasing company was owned by his son constitutes a significant conflict of interest and a clear breach of his fiduciary duty of loyalty and disclosure to the seller. The seller had a right to know about this relationship as it could influence negotiations or the terms of the sale. When a broker breaches their fiduciary duty, particularly by failing to disclose a significant conflict of interest, they typically lose their right to a commission. This holds true even if they found a ready, willing, and able buyer or secured a fair price. The law prioritizes the integrity of the agency relationship. The seller would likely be able to void the contract and not pay the commission. While parties can always compromise, legally, a court would likely find that Bart's breach was so severe that he is not entitled to any commission. Question 797. Which of the following would not be considered a good opportunity for a real estate investor? A. Good property in a declining neighborhood. B. Poor property in an up-and-coming neighborhood. C. Underperforming property. D. Cosmetically damaged property. Correct answer is a good property in a declining neighborhood. In a declining neighborhood, property values are likely to depreciate, making it difficult to achieve appreciation or attract quality tenants, even if the property itself is in good condition. The neighborhood's trajectory often outweighs the individual property's quality in the long run. This is generally not considered a good opportunity for a real estate investor. Poor property in an up-and-coming neighborhood is often considered a good opportunity, the worst house on the best street principle. The rising tide of the neighborhood can lift the value of even a poor property, especially if it can be improved through renovations, flips or rentals. Underperforming property is usually a good opportunity. An underperforming property might mean it's mismanaged, has below market rents, or has unaddressed issues that, once corrected, can significantly increase its value and income. Investors look for ways to add value. Cosmetically damaged property is almost always a good opportunity. Cosmetic damage, like outdated paint or worn carpets, is typically inexpensive to remedy. Despite its minor nature, it often creates a perception of low property value. This allows investors to acquire properties at a discount and significantly boost their worth through simple, superficial improvements. Therefore, the option that would not be considered a good opportunity for a real estate investor is good property in a declining neighborhood. Question 798. A property is listed for sale with an agreement to pay the broker a commission of 7% of the sale price. The broker decides to pay 40% of the commission to his salesman. Now, if the property sells for $650,000, how much commission will the salesman earn? A. $18,200. B. $22,000. C. $45,500. D. It is unlawful for the broker to compensate the salesman out of the commission the broker earned. Correct answer is $18,200. Formula: P equals WX commission, percent. Change the percentage, 7%, to a decimal number. 0.07, P equals $650,000 times 0.07 equals $45,000. The total commission is $45,500, of which 40% of the total commission will be passed on to the salesman. Again, apply the percentage formula to determine the amount of the salesman's share. P equals $45,500 times 0.40 equals $18,200. Question 799. If rises are seen in both the employment rate and overall consumer confidence, then the following will likely occur in the next several months, except: A. Personal income will go up, B. New home construction will rise, C. Existing home sales will increase, D. The stock market will rise by at least 15%. Correct answer is D. The stock market will rise by at least 15%. Increased employment and consumer confidence often lead to wage growth, more hours worked, and job security, all contributing to higher personal income. This is also very likely. With higher employment and confidence, people are more secure in their jobs and finances, making them more likely to buy homes. This increased demand stimulates new construction. Similar to new home construction, higher employment and confidence mean more people are financially able and willing to purchase homes, leading to increased activity in the existing home sales market. While a strong economy with rising employment and consumer confidence generally has a positive impact on the stock market, predicting a specific percentage increase, like at least 15%, is speculative. The stock market is influenced by many factors beyond just these two indicators, including global events, corporate earnings, interest rate expectations, and investor sentiment, which can be volatile. There's no guarantee of such a precise or substantial rise. Therefore, the one that will not likely occur, or at least cannot be predicted with certainty, is the stock market will rise by at least 15%. Question 800. Proposition 58 excludes from tax reassessment property that transfers between: A. Government agencies, B. Government and privately owned businesses, C. Parent and child, D. Public universities. Correct answer is C. Parent and child. Proposition 193 provides protection similar to Prop 58 for property transferred between grandparents and grandchildren. These propositions excludes from tax reassessment property that transfers between parent and child. This means that if a parent transfers a property to their child, the property will not be reassessed for tax purposes. This can be a significant tax benefit, especially in areas where property values have increased significantly. Question 801. Stan conveys an apartment to Ian for 3 years. After the 3 years are up, Ian continues to live in the apartment and Stan does not try to have him evicted. The parties now are said to have A. Tenancy for years, B. Tenancy for non-freehold estate, C. Periodic tenancy, D. No tenancy exists of any kind. Correct answer is C. Periodic tenancy. Let's analyze the types of tenancies. 1. Tenancy for years, or estate for years, is a lease for a definite, fixed period of time. The lease automatically terminates at the end of that period without the need for notice from either party. Stan's initial lease, to Ian for 3 years, was a tenancy for years. 2. Periodic tenancy is a tenancy that runs for a successive, repeating period, e.g., month to month, year to year. It automatically renews at the end of each period unless either the landlord or tenant gives proper notice to terminate. 3. Tenancy at will is a tenancy that lasts only as long as both the landlord and tenant agree. It can be terminated by either party at any time without advance notice. though some jurisdictions require notice. 4. Tenancy at sufferance, or holdover tenancy, occurs when a tenant who rightfully came into possession of the property, e.g., under a lease, remains in possession after the lease expires without the landlord's permission. The landlord can choose to evict them. In this scenario, Ian initially had a tenancy for 3 years. After the 3 years, Ian continued to live there, and Stan did not try to evict him, implying permission or acquiescence, and presumably continued to accept rent. When a tenant holds over after a fixed-term lease expires, and the landlord accepts rent, the tenancy typically converts into a periodic tenancy. In most residential situations, if rent was paid monthly, it becomes a month-to-month tenancy. The initial tenancy for years has ended. No tenancy exists is incorrect because Ian is still occupying with at least implied consent. Tenancy for non-freehold estate is too broad, as tenancy for years and periodic tenancy are types of non-freehold estates. Therefore, the parties are now said to have a periodic tenancy. Question 802. Lea pendens remains in effect. A. While the case is being decided. B. During court proceedings. C. Until the court's judgment is final. D. Any of the above. Correct answer is D. Any of the above. A lea pendens is a recorded notice. It alerts everyone that a lawsuit is ongoing. This lawsuit must affect the title or possession of a specific property. The lea pendens stays active throughout the entire legal process. This includes the time the case is being decided. It remains in effect during all court proceedings. The notice only stops being valid when the court's judgment is final. This means after any potential appeals are resolved. Question 803. A deed restriction would be enforced by A. Court injunction. B. Zoning official. C. District attorney. D. The Bureau of Real Estate. Correct answer is A. Court injunction. A deed restriction, also known as a restrictive covenant or CC&R covenants, conditions, and restrictions, is a private agreement that limits how a property can be used. Unlike zoning laws, which are public government regulations, deed restrictions are created by private parties, e.g., a developer for a subdivision, or a previous owner. Their enforcement mechanism is primarily through legal action initiated by those who benefit from the restriction. Zoning officials enforce zoning laws, which are public ordinances set by the local government. They do not typically enforce private deed restrictions, though sometimes deed restrictions may align with or be more restrictive than zoning laws. A district attorney is a public prosecutor who handles criminal cases. Deed restriction violations are civil matters, not criminal ones. The California Bureau of Real Estate, now the Department of Real Estate DRE, licenses and regulates real estate professionals. While they ensure licensees comply with fair housing laws and ethical standards, they do not directly enforce private deed restrictions between property owners. Court injunction is the most common and effective way to enforce a deed restriction. If a property owner violates a deed restriction, a party who has the right to enforce it can file a lawsuit asking a court for an injunction. An injunction is a court order that compels the violating party to stop the prohibited activity or to take specific action to comply with the restriction. Question 804. The Internal Revenue Service will treat a real estate salesperson as an independent contractor if the Question 804. The Internal Revenue Service will treat a real estate salesperson as an independent contractor if the A salesperson's compensation is based wholly on sales, not hours worked. B. Salesperson has a real estate license. C. Salesperson has a written contract with his broker stating that the salesperson is to be considered as an independent contractor for tax purposes. D. All of the above requirements must be met. Correct answer is D. All of the above requirements must be met. The Internal Revenue Service, IRS, has specific criteria for classifying real estate salespersons as independent contractors. It's often referred to as statutory non-employees, under Section 3508 of the Internal Revenue Code. For a real estate salesperson to be treated as an independent contractor for federal tax purposes, all of the following conditions must be met. 1. All of the compensation for services performed must be directly related to sales or other output, e.g., commissions, rather than to the number of hours worked. 2. The individual must be a licensed real estate agent. 3. There must be a written contract between the salesperson and the broker providing that the salesperson will not be treated as an employee for federal tax purposes. If any of these conditions are not met, the IRS may classify the salesperson as an employee, which has significant implications for payroll taxes, withholding, and benefits. Question 805. The provision stating, "A realtor shall not publicly disparage the business practice of a competitor," appears in the A. Commissioner's Rules and Regulations, B. California Business and Professions Code, C. County Ordinances, D. NAR Code of Ethics. Correct answer is D. NAR Code of Ethics. The California Real Estate Commissioner's Rules and Regulations, administered by the DRE, govern the conduct of all real estate licensees in California and deal with legal and regulatory compliance. While they cover ethical conduct, this specific phrasing about disparagement of competitors is more characteristic of a professional associations code. California Business and Professions Code is the statutory law in California that includes the real estate law. It defines illegal practices, licensing requirements, and disciplinary actions. While California law forbids unfair competition and misleading ads, it doesn't specifically mention publicly disparaging competitors. That particular standard is a higher ethical expectation. You'll find it within professional codes, not typically in broad legal statutes. County ordinances are local laws and would not contain such a general ethical standard for real estate professionals nationwide or statewide. The National Association of Realtors, NAR, has a comprehensive code of ethics and standards of practice that its members, who are called realtors, must adhere to. This code sets a high standard of professional conduct and often includes provisions regarding interactions with other real estate professionals, including avoiding public disparagement. Specifically, Article 15 of the NAR Code of Ethics addresses this, stating, "Realtors shall not knowingly or recklessly make false or misleading statements about other real estate professionals, their businesses, or their business practices." Older versions, and common interpretations, often use language very similar to the statement provided. Therefore, this provision appears in the NAR Code of Ethics.